Okay, everybody, I'm just opening this up. We have 9:59 a.m. Pacific Standard Time, and I just wanted to provide you with just a little opening. This is our first attempt, my first attempt at hosting a webinar, so there might be a few clunky moments, so bear with me, but we're going to give it maybe a couple of minutes of grace period, and then we can move forward. My name's Keith Stoller, and I'm an enrolled agent. I own Concierge Tax Relief and Concierge Tax VIP, and I am also co-founder for San Joaquin Accounting and Tax. That I had started with another founder Sylvia, back in 2002. So I've always maintained a relationship here. And so on behalf of San Joaquin, I'm actually conducting this webinar. And I'm essentially working as a consulting tax strategist here. Right now it's tax season, so I'm fairly available here as well as my other endeavors. And I'm also available off season, but we also have a couple other people, Rob Hernandez, as well as Sylvia Delgado, who can more than happily assist you with anything if you feel that the Augusta Rule is a tax planning tool that may be very helpful for you. So it is 11:01. I'll give it just another 30 seconds or so, and then I'm going to get cranking. I'm going to try to not rush through this. I blocked off the full hour to discuss it. And in reality, it's probably about a 35, 40-minute presentation. So there will be room for Q&A after. So you're always welcome to chime in. But I recommend if you have questions, you put them in the Q&A section. I entered in chat, so please put questions in the Q&A section. I'll be covering your questions at the end of the slides. That's exactly how I put it. I'm looking at it right down there. So without further ado, I will begin. So again, Augusta Rule, a powerful tax planning tool. And how powerful is it? This is one of the most powerful tax planning tools that we have. Other CPAs are aware of it, so if you have a good CPA, accountant, they may be able to help you on this. If you have a good relationship with them, great. But we're always looking to have a free consult or talk to you or even present a second set of eyes if necessary. So feel free to reach out to us over at San Joaquin, 661-325-1421. We have a 800 number. It's 844-465-7829. And then let's go forward. So with the Augusta Rule, moving into the next slide. So what is the Augusta Rule, right? This, in the tax code, it's known as Section 280A, Code G. And, hey, Rob, could you put yourself on mute, please?
Pardon me?
Could you put yourself on mute? I'm hearing everything in the background, and it's being recorded.
Hang on.
Thank you, sir. Okay, so we got that fixed, and all the little things you're learning. I know there's a mute feature. I haven't gotten to that part yet, so live and learn. So anyway, the Augusta Rule allows homeowners or renters, actually. So if you have a rental or lease agreement for your primary residence, secondary residence, or even a vacation home, you can utilize this strategy under certain circumstances. The interesting thing about this, and the reason it's so powerful, is that the income that's generated during the period, the 14-day period that you can use throughout the year for the residents, is not taxable on your return. It doesn't mean it's not reportable, but it does mean it's not taxable. And we'll talk about that in a little while. And so I'll move forward through the slides. And so where did the Augusta Rule come from? Well, Augusta. It originated in Augusta, Georgia. And it was created to benefit the residents around the Augusta Golf Course, who usually rented out their properties for a week or two before, during, and after the Masters Golf Tournament that's traditionally held in that location every year. This was done back in the mid 70s, and the people that were there that owned and controlled the properties had enough connections that they lobbied and they got it. They worked with Congress and got this codified into the Internal Revenue Code to apply nationwide beginning October of 1976. So 1977 was the first tax year you could look back on that. And it's because it didn't just benefit, they can't just make a lot of benefit, just people in a certain area. If on a nationwide level, if they're going to pass a law, it has to apply to everybody or it can be compromised. So how do the mechanics of the Augusta Rule work and why do you want to use it? So taxpayers rent their primary and secondary residence and potentially a vacation home for up to 14 days in a calendar year. There are constraints on that. The rental income is not taxable as long as the home is used personally for at least 15 days during the year. That becomes important. So if you only use the home as your personal residence for 12 days out of the year, and the rest of the year you're elsewhere, this is not going to work for that particular residence. And the rental period that you can utilize is 14 days or fewer. And we're going to get into some real easy math here in a bit. The owner does not allocate or deduct expenses related to the rental though, because since you have the income and it's tax free, if you're actually taking expenses on this in relation to the rental, then it's essentially you're double dipping. And and the government doesn't want that. So that is a limitation that you're going to have to be aware of. So who's eligible? People with primary residence and vacation homes qualify. You can also have a secondary residence. You do not actually have to own the home. You can rent or lease it as long as it allows you to, say, sublet or utilize it in an appropriate way for meetings, business meetings, things like that. So there's a lot of flexibility, but each jurisdiction is different. Each rental agreement, lease agreement is different. So I would run yours by a qualified attorney before you implement this. Now, again, repeating, you must personally use the property for at least 15 days in the year, and the rental use may not exceed the maximum, that is the lesser of 14 days or 10% of the total usage. That's where 15 days starts to come in. Business owners, this is more of a note, that business owners often use this home strategy to hold meetings at their home that they can charge to the company and then report the income, deduct it off of their taxes under this strategy, and effectively have no taxable income. So a little bit more into the math. To take full advantage of the 14 days of tax-free rental period, you must use the property as your residence for personal use for at least 140 days per year. So personal use could be your vacation home. So that's an option, or your second home. So that's why the verbiage is made that way. So to give you an example, 10% of 140 days of residence in the property allows you the maximum of the 14 days. And this satisfies the lesser of rule, allowing you to max that out. So example calculations. You use your home for 200 days for personal purposes in a year. 10% of 200 days is 20 days, but the Augusta Rule caps at 14 days. So those extra days aren't going to help you any. So you're allowed to get the 14 days, but no more. Your home for, let's say you use the home for 100 days for personal purposes in a year. Sometimes this applies to secondary or seasonal homes. 10% of 10 days, well, that's less than 14. That's 10, in fact. And so you're only able to leverage 10 days out of the year for that particular property. So why would you want to use it? Tax-free income. It adds income to your household without increasing your tax liability for that extra money. It potentially reduces the income from your business because if your business is renting it from you, the business takes a rental expense, and then you show revenue or income, and then you can write it off against that, disclosing that it's exempt under the 280 provision. And then you've met your disclosure requirement for income in case of audit and such. And then you basically net zero on the tax for that amount of money. And a lot of businesses, they rent the home for meetings or events. Sometimes they do that for recording social media, say content. And that gives a lot of social media content providers an extra way to use their private residence and subsidize it with business income that's tax-free. Nice deal. Let's see, simple compliance. Well, there's really no reporting or allocation of the expenses. So you don't necessarily need to keep track of the line items under typical circumstances, you just have to report the income and then write off against that in full so that you can receive the tax benefit. This is not, however, a how-to. I'm not going to show you the actual tax forms. That's kind of what we do. So if you want to learn more about that, give us a call. The information will be towards the end. So can non-business owners use it? Well, absolutely. The people over in Augusta, Georgia, didn't all necessarily own businesses. They just wanted to rent the place out when they're not using it and make a few grand in cash that they don't have to pay taxes on. And this could happen for you. So why would non-business owners use it? As in the first example, it's a simple way to generate tax-free income for special events or limited rentals. There's no requirement to run a business or deal with complex deductions. So just because you're not necessarily a business owner doesn't mean that you can't benefit from this if you have an opportunity to rent your property under a limited basis during the year, especially during key times. We'll talk about key times in a little bit. There is a caveat. You cannot deduct the expenses related to these 14 tax-free rental days. So you can't go negative, but you can go tax-free. So who the Augusta Rule is not for? TAR. I'm just calling it TAR as an acronym. So there are predominantly two, and that is sole proprietors who are trying to deduct it from as a business expense and then get it tax-free personally. You can't do that for them, and you can't do it for single member LLCs because they report on Schedule C, and it's basically the same thing, which is and also it cannot be used in conjunction with business use of home deduction on your tax return. I'm not going to get too much into the weeds on that. It's just pointing out that if you get the fractional benefit of I'm writing off a percentage of my home from my home office against my business income, then that actually blows the 14-day rule because it's over the course of a year. So these are very key elements that you're going to have to be aware of. But that doesn't necessarily preclude you from implementing it if you are just renting the property independently, like an Airbnb, something on the side where it's not actually a business, or you're renting just for the occasion of the 14 days. But you do have to worry about that business use of home deduction. Again, it blows it out, and all the money that you think you just saved is subject to taxation. And even if you report it the other, as if it were, then it will come back and haunt you in an audit. Everyone's going to throw on penalties and interest, and we definitely don't want that. So please pay particular attention to this. All right, moving forward. Individuals hosting short-term renters. These are non-business owners that can use the Augusta Rule. So again, Airbnb, short events, you're just renting out your home. Homeowners can rent out their property for events like weddings, family reunions, major local events. Maybe you live in an area where the Super Bowl is happening. Hey, that's pretty cool. So those are things to think about. An example is renting your home during, the Augusta golf tournament for the Masters. Or the Super Bowl, college graduations for major universities. Those are all beneficial. All right. Vacation homeowners. So owners of vacation properties can rent their homes for up to that 14 days. And maybe you're taking a really long vacation, but hey, maybe you stay there a month or 21 days, 3 weeks a year. Then you have some options there. Maybe you don't make 14 days, but 1 or 2 doesn't hurt. Okay, a beach house. Owner rents it during peak summer weekends. So maybe the owner stays there during times they want to, but hey, I'm not around all the time. I've got somebody to clean it. Then let's go ahead. I'm going to be gone for 3 days. Get somebody to clean it up, stage it. I'm gone, making a few grand, and then I'm back. It's already cleaned up before I get there. Hopefully, not too much the worse for wear. Another practical example, business owners also rent their home to a company for monthly board meetings. The rental rate could be set at, and this is an example, it may not apply to you, so don't just take $1,000 as gospel, but the rental rate might be set at a fair market value of $1,000 per day. Not so outlandish as you might think if you're doing your homework. The total income for 12 meetings at $1,000 a day each is, guess what? $12,000 during a year that you can move from business profit into your pocket as the renting owner, and zero taxable income for that rental income. Not too bad, especially if you're in a higher tax bracket, and especially if you live in California. On top of it, California does comply with that rule. So one of the few benefits to living in the state from a tax perspective. So staying good with the IRS, because they're the ones who will scrutinize this more so than anyone else. So fair market value. you must, so that's about talking about that $1,000 example. Well, maybe that's a little bit high. There are many different ways to look at and establish what fair market value is. And it's not just, say, Airbnb rates in the local area. It could be any, say, one of those big events in your community that you can rent during where all the rental rates are much higher. It could also be, say, oh, let's see. Let's say the type of rental you're doing. So are you renting it for an event like you're going to host a wedding there? It's a big property with a big backyard. That might necessitate, you could justify higher rates because you're going to be looking at different comparable values. Whereas if you're just renting it like an Airbnb for a night in that area and it's not any particular special occasion, your justifiable rate may be significantly lower. And then if you're renting it for recording purposes, this is actually like renting a venue. I've been a union member of the Screen Actors Guild for many years now. And if you're renting it for recording, and again, for social media, for content development for your business, and you're going to, in one day, shoot content for the month, which a lot of people can do once they get fairly good at it, and they're going to shoot it out of their home, you've just validated a much higher rate in many cases for each day. All right, but the IRS requires you to establish the fair market value to avoid challenges or penalties from an audit. Now, you can't stop them necessarily from auditing you. You can reduce the risk, of course, with good tax accounting and planning and tax reporting, but they could select you at random too. And it's not a problem. It's a nuisance because of the time that you're spending on it, but it's really not a problem when it comes to you having the answers in the backup. That's why doing the homework before you implement this is very important. And if you're not comfortable with it, having a knowledgeable partner like Joaquin and my team would be very valuable. So again, feel free to book a free consult, no obligation, but just to learn a little bit more. While there's no officially stated maximum, practical tests of best practices offer guidance on setting a defensible fair market value. So that's that defense against audit that I was talking about. So factors influencing fair market value, and again, a little bit of repetition, but that's why it's so important. I'm just trying to drive it in, make sure it gets through the mind. Researching short-term rental platforms like Airbnb or Vrbo to find properties of a similar size is one way, but you need to look in the same location, same quality, and roughly the same time frame as the rental to be thorough about it. So an example of similar homes in your neighborhood are renting for $1,000 a day during some local event. You can use that as a benchmark as long as you get that information that supports it and you keep examples of it. We'll touch on that in a second. Factors influencing fair market value. So timing and demand, fair market value may be higher during peak local events. We talked about that. And we're just using the Augusta Golf or the Masters Golf Tournament as an example. And that can be very significant. Mardi Gras, down in New Orleans, they can run pretty high during Mardi Gras. So that's another opportunity for some folks. More factors that influence it include amenities and the space. So if you have a property that has a pool, especially if it's it's more spacious and accommodating a good sized group, as well as it's kind of like a house that's basically made for entertaining, then you can have that party house. Also, if you've got great parking for larger groups. On top of that, then that actually enhances the value, and you can compare and contrast local comps when you do the comparable analysis, fair market value analysis, and say this property offers more, and find ways to justify that. This is one of those ways. Also, a well-maintained home with special features justifies higher rates. And let's say you're wanting to rent a mansion in the Hollywood Hills or something. You can justify many thousands of dollars a day just for renting that, depending on the context of the rental. So purposes of rental, if the rental is for a business meeting, which is common for business owners using the Augusta Rule, the base fair market value, you have to base the fair market value on what similar meeting venues in your areas are charging. That could be, in this case, hotel conference rooms, co-working spaces, or places that are set for events because, trust building or team building exercises where you have people that they get on a ladder and then their team is supposed to catch them as they fall off backwards. If you're hosting events like that, then that also can influence the value within this context. All right, key IRS audit triggers and pitfalls that you're going to want to be aware of. And this is whether you're a business owner or you're just doing this on the side to rent your property out for, on a personal basis. So Airbnb type non-business owner getting a 1099 miscellaneous or 1099K. So if you're not doing a private renting privately, then and you're doing it through a platform like that, you may still very well, especially if you do over $600 in business, get a 1099, and the government gets that. But if you don't disclose the revenue, not the taxable income, but the revenue, and then write it off appropriately to counter that back down to zero, then it can trigger it on. It's like, oh wow, this is a lot of unreported income. In some high cases, $30,000, $40,000, that could put you into a gross underreporter category. You don't want that because then you actually get the criminal division involved with the IRS, and it doesn't go. It's a lot harder to deal with. You can deal with it if you've got the backup, of course. But if you're underreporting, that triggers it. Also, audit. If let's say you just got audited at random, or because there's something else that's weird about your tax return, and this is a full audit, a sit down audit, they tend to get all your bank statements, all your income statements, and then they're going to go and sit down and make sure this lines up. And they may say, oh, wait a minute, you've got deposits in total well over your reported income. So where did this extra money come from? And then you've got explaining to do. Can you explain it? Yes, but do you really want to have to deal with, do you really have to want to swerve and scramble at the last minute to answer that? And the answer is no, because it's just going to add to your stress. That's why doing your homework on the front end is very important, and teaming up with an accountant who understands this and can help you do it and coach you through it or do it for you even is beneficial. Oh, something else is if you're doing this in conjunction with your business, that's a qualified business. That is sole proprietorship, no. Single member LLC, no. But multi-member LLCs, S corp, C corp, you can utilize this, but you have to have the proper board or member resolutions. So even if it's just you, you've got to have your meeting. Which could be very informal, but you still have to have the meeting, document it, have your resolutions and recording of the minutes, and resolving that, yes, we're going to rent the property or enter into a lease agreement with private individual who is more than likely the owner of the company or a significant owner of the company, and implement this. Because if you don't do that, then and you don't have the corporate records, which is something else that the IRS looks at, and also in a lawsuit they look at, then you're going to be in a very bad situation. And we have a business partner, or not business partner, he's an affiliate, and we send referral business to him, and that's the primary thing his company focuses on, that and asset protection. And if we refer you, you get a full year of this for free, and you'll find the value very quickly. Businesses not entering into a rental or lease agreement with the board member approval. So let's say you get your board member minutes and resolutions and you recorded them, but did you actually go so far as to formally write a simple rental or lease agreement? Well, if you don't have that down, even though it's been approved by the board, that's also a problem, because you want some documentation that will give you structured terms that can be referred to. So in reality, a handshake is just really not enough in an audit situation anymore. So we want to make you as audit proof as possible when it comes to, or bulletproof as possible when it comes to audits. So this is something else that we might be able to help guide you on, but there's things like Rocket Lawyer, all kinds of other services you can do for cheap to create a lease or a rental agreement between the company and the private individual who is renting that property. Also, if the entity is claiming the rental expense, but they're not issuing a 1099 miscellaneous for the or from the business to the person who receives the rent when required, then that can create an audit risk for the business, because if an auditor sees that you should have done that and you didn't, they could actually disallow the write-off. That's in extreme cases. Most auditors are reasonable, but they also have their standards to follow, and they could very well deny that. And then you're back in the situation where all of a sudden you've got the penalties and interest. You're not saving money on on the business tax side, and you probably won't, as long as you've reported the revenue and then written it off on your personal, you should be all right. But it could cause the government to look, and we don't want that. So here you are. Moving forward, practical maximums for the Augusta Rule. I mean, maximum prices. So these are some examples to kind of give you some context here. So business rentals, internal use. So fair market value. This is for inside the company. So a fair market value for meetings held in a home typically range from about 500 to 1500. There are examples where they're higher. There are examples when they're a bit lower, but this is a pretty healthy range here. And of course, it depends on the market and the home quality. It could even be influenced by the time of year. And this, if you're just doing meetings, that's one thing. If you're doing different types of events, like in extreme examples, of course, social media recording for content, for marketing and advertising, this is something that's important. Uh, Real estate agents can really leverage this. Now, in high demand or luxury area homes, fair market value can exceed $2,500 a day with proper documentation. And event-driven rentals, we talked about that, but the reality is, I actually recently looked into this because some of my knowledge was a little outdated as far as really what fair market values are. But short-term rentals, that is, let's say you're something in the Super Bowl or Mardi Gras or Augusta Golf Tournament, they can command between $5,000 and $15,000 a day, depending on the type of property, and especially in very exclusive areas. Let's say you're in Bel Air, and you're staying for some event there. Renting a state property is going to be more towards the high end of that. I'm just simply giving you an example. However, it has to be justified with documentation during that period. And again, listings for comparable properties, we're going to go into that. So fair market value, best practices. So first off, when you're looking to justify what a fair market value is for you, then you want to take screenshots of similar properties that are rented in your area during that time. If you can get a time date stamp on it, it's even better. And that will constitute some of the proof that you will need. And you will want to include data for similar sized homes with comparable amenities and locations. So if you're comparing an estate property, you want to compare it to an estate property in the same area or region. Closer is better, of course. Also, let's say if the people at the end of the cul-de-sac, those homes might command better because you go out on the balcony, you get to see the event better. Okay, fine. Whereas people that have houses down the block that don't have that same luxury, not as good. So they won't command nearly as much. So getting a written appraisal is something else you can do, and it certainly would only help. But a professional appraiser, a rental agent, that would in California, that could be a real estate agent who specializes in rentals, commercial properties, things like that. They can go ahead and write a letter supporting your fair market value. Maybe they charge a little fee for that. But if you're writing off tens of thousands of dollars, then it's certainly, I would think of it as an investment. But this written appraisal, it's not just for businesses. You could do it privately as well. If you're doing the rental privately just for yourself as a homeowner, or you have a lease on the property and you want to sublet for the event. So consistency and reasonableness. So you're going to want to avoid claiming excessive rental rates far beyond local comparables unless they are supported by unique circumstances. So you've got the one great house in an area that's otherwise a dump. Well, it's a little bit different. You got security, guard dogs, whatever. You want to be able, or you're in them, let's say you're doing a retreat, like the example here, in a luxury property that's otherwise, let's say it's in the hills, in the mountains. And most of the homes around there are modest and couldn't normally command a rate like that. But your property, the property you're renting or wanting to rent is premium, it has luxury amenities, and stands out from the properties, then you can look at that, but you have to document, here's pictures of the property, this is what everything else does. And there are properties in similar locations that are similar to mine that I can utilize. That's the kind of research that you're going to need to do. And it's going to take a little bit longer because you're going to have a broader search. Again, qualified real estate agent that especially deals with leasing and renting would be more likely to help or be able to direct you to somebody who can help that specializes in that. So if you have a good connection, they can refer you if they're not the right person for that particular task or they don't feel up to it. So audit considerations. We talked a little bit about it, but in this particular case, EPK, that's not even a word, but here we are. Insure, provide, and keep. So you're going to ensure the rate is not inflated. Now, if you've got a broad range and you've got a midpoint and your property is a little below that, then you make adjustments. If your property is better than that, well, you don't necessarily have to stay in the midpoint, but if you qualitatively have a better property, then you can go towards the higher end or start approaching it. as long as you have the documented proof. So providing evidence like comparable listings, invoices from local venues, so like the hotels and such, maybe they present you with a proposal or an invoice about meetings during this particular day or over a period of days. You're going to want to look at that. Now, if you, one thing as a side note is you're going to want to get the quotes from a 1 day rental, because sometimes, especially with hotels and venues, if you're trying to rent the same space for multiple days, they're going to want the revenue, and so they may cut you a better deal. You want the 1 day rate or the half day rate, whatever it is. 12 hours could constitute a day. Actually, 4 hours and 1 minute technically constitutes a day, especially for travel purposes. But you think about it in an 8 hour day. If you're going to have an 8 hour event, there's going to be 2 hours in front, especially for social media shoots, that you're going to want to reserve for setup, and there's going to be a 2 hour buffer for teardown, and then there's going to be the 8 hour production window. That could vary, but this is just giving you an example that you don't want to just book the time for the actual production or the meeting portion. You also want to have the buffer for the front and the back end. All right, keep meeting agendas, contracts, and other supporting documentation. So if this is a business meeting or content generation session, then if you're generating content, oh, you've got all the clips. Here we go from that date, and then the IRS says, oh, okay, and they go away. Yeah, same thing if you said, okay, we're going to have a board meeting here at this property at my house, and here's the meeting, here's the agenda. Maybe we have minutes if it's a board meeting. Maybe we've executed contracts, or there is a contract executed specifically for that rental, which there should be if it's your own business, especially for audit purposes. Those are things that you're going to want to have in place to the degree that it's appropriate in your situation. Okay, another fine mess. So home office rent. So these are the things where things might fall apart. And I'm just trying to highlight that. So paying home office rent issues. So the corporate business owner who's also an employee may recognize income, but there's no recognition of expenses as an employee with an S corp. So in other words, if the business is renting the office from you over the course of a year, like on a month by month basis, then yes, the employee is going to recognize that rental income. However, you can't do the recognition of expenses typically. In this particular scenario, because employees, and this is for federal purposes, states don't always comply. California does not comply with this, so you still don't want to do the calculations. But for federal purposes, it messes you up. And also doing this, the month by month rent is blowing the 14-day limit, as it's deemed a rental income. So everything is now taxable. You don't want that. So there's a workaround. Okay. Let's see. So what is that workaround? What's the fix? It's called an accountable plan. And I think next quarter, what I'm going to do there, because there are many types of accountable plans, this is the one that helps so that you can do the Augusta Rule as well as have home office reimbursement. And that's what the trick is. So if you're going to pay the employee, the shareholder, they're reimbursed for the office expenses that are related, the square footage of the room, because it's not income. It's a reimbursement for expenses, and therefore that 14 days doesn't run, and you are in a great situation. And you can utilize that. But to set up an accountable plan, you actually have to have board minute resolution, setting up the accountable plan, and then you actually have to have written document saying this is the accountable plan, this is how it works, and then you need to follow it. Okay, and you have to be consistent about it. This is not something you want to be rushing at the last minute to put in place. So there were some examples of expenses that are not rent, reimbursement for internet, portion of the utilities, the proportion of mortgage, interest, property taxes, or your rent. If you don't actually own the property, if you're renting or leasing, you can write off that portion, or not write off, but you can get reimbursed for that portion based on what your actual expenses are. And so the company writes it off, you get the money tax-free, and you can still take advantage of the Augusta Rule, but you have to do the front end work on that. All right, now since it avoids the rental income, the Augusta Rule remains in effect. So I basically just said that. So what are some takeaways? So we're coming to the end of my active presentation here. I'll have a little Q&A session here in a little bit. I might even turn Rob on if he wants to ask some questions. It's a small turnout. I'm going to be sending this out to people who didn't show up that may benefit from this. If that's you, then or you know a friend, then go ahead and shoot an email over to me, ops@sjats.net, and I'll be happy to send a link to them. Let's see, and that should be available in an hour or so after this meeting. So enjoy. Today is February 15th, 2025. All right. So moving forward into the takeaways. Hydration. Okay. So, and it's more about considering the following. Am I really qualified? Well, you potentially can be, rent, own. However, the thing you have to be aware of the things that we just talked about, which are the things that may mess you up, especially if you're a business owner. You have to stay within the 14 days. So if you have somebody that's renting a room from you, this is also something that would mess up. So let's say you're renting, subletting or a room inside your property during the year for a portion of the year at a month at a time. You can't use the Augusta rule on that. Um, is my business structured properly? Well, that goes back to if you're trying to use this in conjunction with business, sole proprietorships, no. Single member LLCs, no. However, this is something that can be beneficial for everybody else. So maybe you need to have a discussion with your accountant about perhaps modifying the structure of your business. If you have a single member LLC, there is something you can do, and that is you can have it modified because you can actually have tax filings for an LLC, a single member LLC, as either an S corp or a C corp. There's a process for that, and it's an election. But you would probably need our help for that or your accountant's help. But once you get it, even that single member LLC, if you structure it in that particular way and you report in that particular way, then all of a sudden you have a way to make it happen. So some people that do have single member LLCs, they're good to go. Am I profitable enough? You would think that, oh, if I'm going to be able to rent my house for say $30,000 a year to my company and then take that tax free, but I run at a loss every year for tax purposes, or even on your balance sheet, bottom line. If you have the cash available, you can still utilize that. You go through the same process I just talked about, and then but what you would do is you're not necessarily going to be, if even if you're getting the money tax free, you may not necessarily be hanging on to it. What you might do in that particular case is you take a further deduction, your business shows a greater loss, and then you can, if you choose, re-inject that money back into the business in a separate transaction from you as the owner into the business, and that will increase your balance sheet situation, and you'll have more cash back in the business. And then also you're going to be looking at increase in owner's equity, or it could be a loan from shareholder. There are different benefits and advantages to each way you do it. That's a longer conversation than this video or webinar is structured for. We have to set up a separate meeting for that. All right. Do I have the paperwork right? That goes back to board minutes and resolutions. And again, this is for business owners. It also goes to private, people who are not business owners that may want to do the occasional rental. Does your lease or rental agreement allow you to do that, or is it specifically prohibited? You have to look at that, and you have to look at it in the context of your own area. Because California has different rules than Florida or Ohio or Alaska or anywhere else. So you have to vet that. And I can't necessarily do it for you, but I can research it if you don't have the time to do it. And we just have to charge for our time to do it. Let's see what else. Oh yeah, consider the following. What are board minutes and resolutions? Okay, well, if you don't really know, and I've mentioned it several times what they are, but if you're not really, it's like not ringing a bell with you at all. It's like, what's still we're talking about? Well, we need to spend some time, and I would recommend maybe a free 30-minute consult. You can book that online. I'll give you the contact information toward the end of this, and you're more than welcome to go ahead and do it. And if you do reach out, I'll get the email or voicemail saying, hey, so-and-so reached out. Here's their email and phone number, and I can send you a link to my digital calendar, and you can get on for a free digital coffee, 15 minutes, or a 30-minute initial consult. So that's an opportunity. Even if you're an existing client of San Joaquin, we'll offer that for you as value-added education. And even if you don't want to do it, at least you're going to know more about the situation and how it can apply to you. Tell me more about accountable plans. I mentioned that earlier. There are many types of accountable plans. The one that I mentioned for reimbursement for home office is just one. Documentation is important. They have something called a medical expense reimbursement plan. That is an accountable plan. It's called a MERP. If that's the parlance inside the accounting and financial industry. There's a medical expense reimbursement plan. So that's another thing. Can you use TAR on multiple homes? Well, yes, you can. So let's say you're one of those fortunate individuals that's done very well, and you have primary home that you're in most of the year, or a good portion of it. Then you have your seasonal home, and then maybe you have a vacation home. on top of that. Or and again, rent, own, lease, whatever. You can actually, and here's the thing, for one business, that's one thing. If you have multiple businesses, you could potentially do that for each property. One of the things to, again, be aware of is how much time do you spend in each of these homes? So, for example, if you are spending, let's say, 200 days a year in your primary residence, all right, so you can do up to the 14 days in that home. You have a secondary residence and a second business. Guess what? Well, let's say you spend 100 days there. Fine. Then you can do 100 days. That's 10 more days with that second business. You have a vacation home. Well, maybe you only spend 60 days there, or maybe let's just say you spend 20 days there. The rest of the time you're traveling, enjoying life. Well, 20 days is very interesting because you have that 15-day requirement to be in the property, and then you can use one day. But if you once you get up to 20, and again, this is where the 10% rule kicks in. Once you get up to that 20 days, then you've got 2 days accessible to you. So if you only stay there 3 weeks, then hey, you've got 2 days that you can write off for yet another business. Um, Once people are prosperous in one business, they tend to have several others, or that other property, it could be related to an event. It may not necessarily have to interact with any of your businesses. It's just using it internally for the businesses is the probably the best lever you can pull because you get the double benefit of reducing your business expenses and reducing any potential taxation on your business and then getting the money in personally and then not having to actually be taxed on it. Isn't that fantastic? I thought so. All right. Yeah, can I get a free consult? Well, I ask because you might be interested. Okay, this says, thank you for attending. I appreciate your sufferance of me. We're coming up to the last 10 minutes of the window that we had for this. Again, Keith Storer, MBA, EA, Certified Tax Resolution Specialist. So if you have problems with the government, federal or state, generally speaking, I can help you or at least point you in the direction of how to do that in the most cost-efficient manner possible. And National Tax Practice Institute Fellow, that is similar to the CTRS. I've just taken a lot of I've taken a lot of continuing education and specialized courses on how to actually deal with the IRS to the maximum effect possible. And even if I might not remember anything in particular at the moment, I may be looking at a problem, I know where to find the information. And so I get up to speed pretty fast. So if you want to book a free 15 or 30-minute consult, go ahead and shoot an email over to info@sjats.net. You can also find our website, sjats.com. And then you can also call our 800 number, 844-465-7829. Although ask Rob to unmute. Maybe Rob has some questions. I don't see anything in the Q&A, but that's okay. So anyway, Rob, I just asked you to unmute if you'd like to. If it's too busy or you're good, no worries. Okay, I'll give it like a minute. And if there's no other questions, then I'll wrap this up. And again, thank you for attending.